All right, welcome to The Explainer. Today, we're diving into a real institutional grade risk briefing, completely dissecting the underlying rot in the massive private credit market. While retail attention is totally captivated by vertical stock charts and on the AI
All
hype,
right.
welcome to The Explainer. Today, we're diving into a real institutional grade risk briefing, completely dissecting the underlying rot in the massive private credit market. While retail attention is totally captivated by vertical stock charts and on the AI hype, professional risk managers, well, they're looking at something entirely different. There's a $2.5 trillion tidal wave building quietly in the background, and frankly, the cracks are just becoming impossible to ignore. We're going to strictly stick to the data, the actual mechanics of the debt, and the pretty wild accounting maneuvers that are currently keeping the whole system afloat.
So here's our structured breakdown for today. We'll kick things off with the macro yield shock, move right into the floating rate trap, break down the anatomy of a default, expose what we call the Pike accounting illusion, and then finally, we'll face the looming maturity wall. Let's get right into it.
Section 1, the macro yield shock. We're starting our assessment right at the symptom. 30-year sovereign bond yields are hitting their highest levels since 2007 in the US. And hey, this isn't just some isolated domestic event either. We're seeing similarly historic highs all across the globe. I mean, the UK's 30-year hit its highest level since 1998, Germany's since 2011, and Japan's 30-year yield is just sitting at an all-time high. When 4 of the largest sovereign bond markets start moving this violently, we absolutely have to pay attention.
So why is this happening? Basically, buyers are demanding way more compensation for locking up their capital. It boils down to 4 things: aggressive Fed rate hikes, persistent inflation eating away at the dollar's future purchasing power, massive Costco-sized issuances of new U.S. debt flooding the market, and a real retreat from foreign institutions who used to be reliable buyers. This situation perfectly illustrates why the adult in the room, the global bond market, is breaking everyone's risk models and basically pulling the plug on the easy money party.
Moving on to Section 2, the floating rate trap. We're shifting to the short end of the yield curve, and this is where the Fed's fingerprints are the most visible, acting as the literal mechanism of risk. The long end asks if you trust the fiscal situation over decades, right? But the short end, that's where the immediate acute pain is being felt today by corporate borrowers.
To really grasp this coming shock, we have to sharply define SOFR, the Secured Overnight Financing Rate. This is the benchmark anchoring almost all floating rate corporate debt. Unlike the older benchmarks, SOFR isn't a guess. It's not a target. It is the literal overnight receipt for the entire U.S. financial system, published every single morning, based on actual, cleared, and settled trades.
And here is the crucial point. SOFR completely skyrocketed from essentially 0 in early 2022 to over 5% by mid-2023. Even with recent rate cuts, it is still sitting way higher than pre-pandemic levels. This is a monumental, compounding rate shock, and it absolutely blindsided heavily leveraged borrowers. Just contrast this with your standard fixed debt. In a fixed structure, you lock in your rate on day one. Your payment never changes, no matter what the macro environment is doing. But in a floating rate structure, which completely dominates private credit, by the way, the rate is pegged to a benchmark, almost always SOFR, plus a premium spread. So when that benchmark shoots up, the borrower's interest payment shoots right up with it. Their cash flow gets critically squeezed, and suddenly their margin for error shrinks to literally 0. From an institutional risk perspective, floating rate loans take that interest rate risk and transfer it directly onto the borrower's balance sheet. Okay, Section 3, Anatomy of a Default. We're going to look at the Pluralsight case as the canary in the coal mine to see exactly how this theoretical risk plays out in the real world. We really need to follow the money downstream to the middle market. Companies that are too big for a small business loan, but maybe too complex for a traditional bank. What's absolutely wild here is the sheer scale of the growth. This middle market lending space has exploded tenfold since 2007. It's now a $2.5 trillion market. And the vast majority of these loans share 2 incredibly perilous traits. They are floating rates, and they never trade publicly, which means all their valuations happen completely in the dark. Let's actually walk through the exact steps of the 2024 Pluralsight collapse, because it perfectly demonstrates the immediate failure point for overleveraged borrowers. Back in 2021, private equity acquired Pluralsight, and they saddled its balance sheet with over $1 billion in floating rate SOFR pegged debt. Now, for 3 years, at near 0 rates, hey, the math worked. But when SOFR spiked past 5%, the math broke. By August 2024, their interest payments were entirely unsustainable.
Lenders basically had to step in, force an equity conversion, and take 85% ownership of the company.
And here's the thing, this isolated default is actually a systemic feature. Just look at this incredibly apt quote about the spreading cracks in the credit market. Jamie Dimon, CEO of JP Morgan, noted on a recent earnings call, "When you see one cockroach, there are probably more." Pluralsight was definitely not unique. It was just one borrower in a massive stack, and nearly all the companies that borrowed from private credit just absorbed that exact same compounding rate shock. Backing up that cockroach theory, the Fitch private credit default rate, which tracks over 500 middle market borrowers, recently hit 6% on a trailing 12-month measure. That is the highest recorded rate since its inception. The data is screaming that the stress is real and it is systemic. For any risk manager running a portfolio, a 6% trailing default rate in this specific asset class is a blaring siren. Which brings us to Section 4, the PIK accounting illusion. If defaults are hitting record highs, how on earth is the industry feigning health? Enter our forensic analysis of some seriously sneaky accounting. This is where we see the finance industry take a somewhat reasonable concept and stretch it to the absolute limit just to mask underlying distress. The definition of PIK is the linchpin of the whole illusion. A payment in kind, or PIK, is essentially a financial magic trick. It allows a borrower to satisfy their interest obligation not with actual cash, but by adding that unpaid interest directly to the loan's principal. It mathematically removes the exact trigger that would normally stamp a loan as non-performing. Contrasting cash versus PIK really reveals how systemic financial distress is being cleverly repackaged as performing income. Normally, if a borrower can't pay cash interest, boom, the loan defaults. That default triggers a restructuring and exposes the damage. But with a PIK, that unpaid interest is just seamlessly capitalized into the principal balance. The balance grows, but technically no payments were missed. The distressed loan is magically still counted as performing, even though absolutely zero cash was received by the lender. Kind of makes you wonder what performing even means anymore, doesn't it? Now let's see how this creates a dangerous chain reaction within business development companies, or BDCs. These are investment vehicles that hold a massive chunk of the private credit market. To keep their zero corporate tax rate, BDCs are legally required to distribute 90% of their taxable income to investors. So watch this chain reaction play out. A borrower fails to pay cash. The loan flips to PIK. The BDC takes that unpaid capitalized interest and actually reports it as taxable income. Then, because of that 90% rule, the BDC has to mail out real, hard cash dividends to its investors based on phantom income it never actually collected. The metrics show that the rot is spreading quickly. Around 11 to 12% of private credit loans now include PIK features. That's up 72% since late 2021. On average, 8% of BDC income is this phantom PIK interest. And for some, it's way higher. FSKR, for instance, is running PIK at more than 14.5% of their total investment income, right alongside rising non-accrual loans. And of the record defaults Fitch recorded recently, over 60% involved the introduction of PIK instead of cash payments. They're literally hiding the losses in the accounting lines. And compounding this entire PIK illusion is how these assets are valued in the first place. These untraded loans fall under the accounting label of Level 3 assets. That is the most illiquid and subjective category out there. They're basically marked to fantasy internally, relying entirely on internal models and unobservable inputs rather than active market data. But despite this subjective padding, MSCI notes that over 10% of private credit loans are already marked down by at least 50 cents on the dollar. The internal models are starting to completely break under the pressure of reality. All right, final section, Section 5, the looming maturity wall. This brings us to the horizon threat. This is where all these accounting illusions are going to violently collide with hard mathematical reality. You can capitalize interest and rely on Level 3 models for only so long before the bill comes due. $85 billion. That single massive number represents the colossal wall of BDC loan maturities rapidly approaching. $85 billion of debt that is currently sitting in this complex web of floating rates and PIK accounting is about to hit its expiration date. Looking ahead over the next few years, specifically from 2026 through 2029, borrowers are going to be forced to refinance their capitalized near-zero debt into today's 5+% reality. This is the exact moment when the PIK illusions just evaporate. When this near-zero debt has to roll over at current market rates, borrowers who couldn't afford the cash interest yesterday will suddenly have to refinance a much larger principal balance at a much higher rate. So as an institutional risk manager, you really have to ask yourself, you can hide a loss in an accounting line. You can roll unpaid interest into a bigger principal, and you can even call a distressed borrower a performing loan. But the math is still the math. When this massive maturity wall hits and the accounting finally catches up, who ultimately pays the price? Take that thought with you as you review your own exposures. Thanks for joining this explainer.